Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves.
Bringing you the market insights that matter, delivered right after the closing bell.
Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only.
Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
Now let's dive in. Okay, so today felt like, well, a bit of a reality check, didn't it? After that record momentum we saw Tuesday.
It really did. A clear defensive retreat seems to be the main story.
Yeah, definitely seeing profit-taking in some of those stretched momentum trades and maybe some positioning ahead of the big stuff coming up.
Exactly. You got the rest of the Magnificent Seven earnings rolling in, and then that crucial CPI report on Friday.
So let's break down that defensive positioning. How did the indexes actually fare today?
Well, it was a decisive reversal of Tuesday's strength, that's for sure. The S&P 500, it closed down 0.53%, landing at 6,699.40. The Dow, which hit that record high just yesterday, shed about 334 points. That's 0.71% down.
And tech usually leads the way down on days like this.
And it did. The Nasdaq led the losses, falling 0.93% to finish at 22,740.44.
So those numbers tell part of it, but the rotation, that's where the real story often is, right? When institutions get cautious, they swap things around. What's this rotation telling us?
It tells us they're moving into safety, but, without hitting the panic button.
Yeah.
It's pretty clear when you look at the sectors.
Yeah. What led?
Classic defensives. Consumer staples was actually the leader, up 1.15%. Healthcare gained a solid 0.93%. And energy also popped, up 0.96%, which is interesting in itself. We can circle back to that.
Okay. And the losers were where you'd expect.
Pretty much textbook. Information technology down 1.00%, industrials off 0.81%, and communication services dropped 0.57%.
So risk-off repositioning, like you said. An organized move, not a mad dash for the exits.
That organization, that lack of panic, you can also see it in the technicals for the S&P 500. Despite the pullback, the index still has a pretty decent cushion above a really key support level.
How much of a cushion are we talking?
About 129 points above its 50-day simple moving average, the 50 DMA. That level's sitting right near 6,570.
Okay, for listeners maybe not glued to charts daily, why is that 50-day moving average such a critical line in the sand?
Well, think of it as the market's short-term health check, especially for institutions. It's the average price over the last 50 trading days. So, yeah, there's some psychology there for human traders, but maybe more importantly,
The algorithms.
exactly. It's a major level for algorithmic trading programs. If the S&P breaks decisively below 6570, you'd almost certainly see systematic selling kick in, which could really accelerate things to the downside. So staying above it, well, it gives the bulls a technical argument that this is just consolidation, not the start of a deeper correction.
So we're not quite teetering on the edge, but maybe looking over it a bit. Volatility seemed to pick up too.
It did. The VIX, the volatility index, the fear gauge, it was up over 4%, 4.09% to 18.60 today. Now, that definitely signals traders are buying some protection, hedging. But the level itself, 18.60, is still below those crisis levels you might see, like above 20 or 25.
So managed risk reduction, like we said. People are cautious, but not panicking.
Precisely.
All right, let's shift gears a bit. Commodities were wild today, a really strange divergence. You had energy surging, but gold getting hammered again.
Yeah, quite the split.
So why did oil suddenly jump when the equity market seems worried about growth? Seems kind of counterintuitive.
It does seem that way, but the oil move looks mostly technical for now. WTI crude, that's the U.S. benchmark, it jumped 2.70% to $58.79 a barrel.
Okay.
And Brent, the global one, jumped even more, 4.70% to $64.20. But this doesn't look like it was driven by, some big new geopolitical flare-up.
And what was it then?
It seems like mostly a technical bounce. It got really oversold earlier in the week, and there was a modest inventory draw, so it's snapping back.
Right, so more of a correction within what might still be a downtrend.
That's certainly how the analysis we're seeing frames it. The conviction that this is a real trend reversal is only about 3.5 out of 5. So the thinking is this rally might not last if the broader economic mood stays cautious.
Gotcha. Okay, so if oil was technical, gold. Well, that seems more fundamental. We talked about yesterday's huge 8% plunge, and today it just kept going down. That's a massive shift for gold.
It is historic, really. Gold dropped another 1.5% today, trading around $4,065.
Mm.
Put yesterday and today together, and that's the biggest two-day slide since, wow, back in 2013.
That's huge. So this isn't just taking profits. It feels like something bigger, like a real reevaluation.
I think so. It suggests maybe a fundamental rethink of global risk, maybe inflation expectations.
Explain that. Why dump the ultimate inflation hedge, the safe haven asset?
Well, two main things seem to be going on. First, just simple liquidation. Gold had that massive 9-week winning streak, tons of speculative money piled in. When things turned, those crowded trades unwound and violently.
Okay, the crowded trade unwind. Makes sense. What's the second thing?
The second, and maybe more profound, is about the inflation story itself. Gold thrives when inflation is high and sticky, eating away at currency value. This kind of severe drop suggests, well, maybe a big chunk of the market is starting to think inflation has peaked.
Or at least that the threat is receding faster than we thought.
Exactly. Maybe the central banks are winning or the worst is over on that front. That's a big potential shift in narrative.
That is critical, because if gold isn't the go-to hedge anymore, where does all that capital go?
Well, one analyst, Michael Van de Poppe, specifically suggested gold might have peaked for now and money should rotate elsewhere. And that leads us right into, well, the relative stability we've seen in crypto.
Right, Bitcoin specifically. It was down a bit today, like 1.35%, but it's still holding that range, isn't it? Roughly $105,000 to $113,000.
Yeah, it's consolidating really tightly there. And that lack of a major breakdown, especially while gold is collapsing, is pretty telling.
Seems like that institutional support is holding up.
It looks like it. We saw another big slug of money go into the ETS yesterday, about $477 million. That keeps demand pretty firm, even while the price is chopping around.
Okay.
And that stability, plus gold's massive weakness, is definitely fueling that idea of a long Bitcoin versus gold trade. Sell gold, buy Bitcoin.
And the conviction score on that idea is 3 out of 5.
That's right. The thinking is, after gold got crushed, maybe Bitcoin offers better risk-reward now. It really highlights how the definition of a safe haven might be evolving.
It really does. An asset that was soaring just had a decade-level drop, while the volatile digital one is just sitting there. The rotation is definitely something to watch.
Absolutely.
Okay, let's pivot back to stocks and earnings, because this is where you really saw the market's split personality today. The theme seems to be execution matters more than the story right now.
That sums it up perfectly. You absolutely have to deliver.
So where did the market deliver, and where did we see those high multiple names start to crack?
Well, the strength that propped up the Dow yesterday came from, the old economy players.
Yeah.
Solid companies with real cash flows. Coca-Cola was up 4.1%.
Nice.
3M really impressed, soaring 7.7% after showing some great operational efficiency gains. And General Motors, wow, just blew the doors off, up almost 15%.
15%. What drove that?
They significantly hiked their full-year guidance, much stronger than anyone expected. Seems like demand is holding up really well for them, despite interest rate worries.
Okay, so tangible results getting rewarded. But on the flip side, the tech space, especially those names trading on big future growth expectations, they had a rougher day.
A much rougher day. A real reality check. You have to be perfect in this environment, and they weren't. Netflix dropped over 8%. She tried to partly blame a tax dispute in Brazil, but, the market wasn't really buying it. Texas Instruments gave some pretty downbeat guidance, signaling the chip cycle's still tough.
And after the bell,
Tesla missed earnings estimates, and IBM was already down about 5% during the session.
so this plays right into that conviction call we've been tracking. Underweight, high multiple tech. That one has a pretty high score, right?
Yeah, 4 out of 5 conviction. This is the market actively trimming risk, especially in those expensive names, before the rest of the Magnificent Seven report.
And there's some broader context for that de-risking, too. Something about bear market indicators.
That's right. Our sources are flagging that 60% of common bear market indicators are now triggered.
60%. That sounds significant. But what does that actually mean for the average person watching the market?
It means that even if the main S&P 500 index looks okay on the surface, underneath, things are getting weaker. We're seeing deterioration in market breadth, like fewer stocks trading above their long-term averages.
Okay.
Plus, you see weakening sentiment in surveys, weaker momentum signals for most stocks. Hitting 60% suggests the rally's been really narrow, led by just a handful of big names.
Leaving most other stocks vulnerable.
Exactly. The clear message is, if you're a high-growth, high multiple stock, you better deliver perfectly or your valuation is going to get squeezed hard.
Makes sense. Okay, shifting outside the market itself, we can't ignore the government shutdown. Day 22 now. Second longest ever.
Yep, dragging on. And beyond the politics, it has a really significant market impact.
Chill.
It creates this dangerous data vacuum. The shutdown has stopped almost all the regular economic data releases, housing, retail sales, manufacturing, you name it.
So the market's flying blind, essentially.
That's pretty much. Usually you get this steady stream of data points to build a picture of the economy. Right now, that stream is almost completely dry.
And that vacuum is why Friday's CPI report, the inflation number that got delayed, is suddenly so incredibly important.
Absolutely critical. Because everything else is suspended, all the market's focus, all the potential volatility, it just lands squarely on this one report. Everyone's desperate for any signal on inflation before the Fed meets next week.
But there's a catch, isn't there? Concerns about the data quality itself because of the shutdown.
Yes, big concerns. Skeptics are openly questioning if data put together and released during a shutdown can even be complete or reliable. And when you combine that potential data flaw with the fact that we have zero context from all the other missing reports, well, it just massively amps up the risk of a wild swing when that CPI number hits.
So the Fed has to make its decision next week with potentially flawed, isolated data.
To a large degree, yes. Their meeting is October 28th and 29th, and they'll be working with imperfect information. The good news, I suppose, is that it hasn't really changed expectations for what they'll do.
The rate cut is still expected.
Oh, yeah. That 25 basis point rate cut is still seen as almost a lock. The market's pricing in like over a 98% probability.
Okay, so the immediate trading implication before Friday seems pretty clear then, given the focus on possibly shaky data.
Yeah, prudence definitely suggests maybe trimming position sizes, adding some hedges before Friday morning. Just be prepared for potential whipsaws.
Makes sense. Manage the risk in this uncertain setup. All right, so let's pull all this together. We've got this defensive move, earnings splits, commodity chaos, data uncertainty. What's the most likely path forward for the market as we head towards year-end?
Well, the view is coalescing around a base case, about a 45% probability of choppy consolidation.
Meaning
We probably don't see a big decisive breakout higher or a major collapse lower. Instead, the S&P 500 likely stays range-bound. Think maybe between that key 50-day average support around, say, 6,550.
Okay, that 6550, 6570 zone.
Right, and the recent highs around 6,750. Just chopping around in that zone through the end of the year. There are just too many conflicting signals right now for a clear trend.
So the market's kind of caught between these opposing forces, solid value earnings versus tech weakness, data uncertainty.
That's a great way to put it. Caught between tides. And that 6570 level, the 50 DMA, that remains the absolute critical line to watch on the downside.
Because a break triggers the algos.
Exactly. A clean break below there likely brings a test of 6,500 pretty quickly. Holding that line is really key for the bulls in the near term.
Okay, so in this choppy, uncertain environment that demands quality, where are people finding opportunities? What fits that defensive but still a growthy theme?
One area getting a lot of focus is a specific sector trade. The long quality healthcare REITs call. That carries a high 4 out of 5 conviction.
Healthcare REITs, why them specifically?
Well, they benefit from really powerful demographic tailwinds, the aging population.
Right.
And they offer this great mix of steady income, growth potential, and defensive characteristics.
Yeah.
They're less tied to the economic cycle than, say, office or retail REITs.
And how have they been performing?
Exceptionally well, actually. They're up, on average, 21.83% year-to-date. That's more than double any other commercial real estate sector.
Wow.
So they really exemplify the kind of quality, execution, and stability the market seems to be rewarding right now while everything else is kind of churning.
So the big takeaway from today, after digging through all this, is that this isn't a market where you just buy the index and hope for the best.
Absolutely not. Forget the broad beta chase for now. This is very much a stock picker's market.
Okay.
The market's clearly rewarding stability, solid cash flow, proven execution over just speculative stories. So for you, the focus should be on diversification, quality, and staying tactical. Maybe ready to add some exposure, but only if that critical 65-70 support level holds firm.
That's all for today's episode of the Daily Consolidation.
For more daily market analysis, subscribe, and we'll see you at the next close.